everyone, and welcome to our podcast, IR in Focus. I'm your host, Carmen Lilly, and I'm thrilled to welcome my colleague, the host of Street Talk, Nathan Stovall. In the next 20 minutes, we'll take a deep dive into the wonderful world of capital markets, recap the year, unpack a couple major events, and then turn our focus to 2024. Welcome, Nathan.
Thanks for having me.
Now, Nathan, I'm so excited to have a spicy crossover between IR and Focus and Street Talk. But before we get started, I know you're much more than just a podcast host, so let me review your street credentials for our audience. Nathan Stovall is the director of the Financial Institutions Research Team for S&P Global Market Intelligence, responsible for data-driven news and research focused on banks, insurers, and fintechs. Nathan has 20 years of experience covering the financial institution sector with a focus on U.S. banks. He has been the author of the banking blog Street Talks and recently expanded his reach and expertise, taking the lead of the podcast by the same names. He has been quoted in a number of trade publications in the national press, including the Wall Street Journal, the New York Times, the Financial Times, The Economist, and has appeared on CNBC, Yahoo Finance, Fox Business News, Marketplace, and NPR's Planet Money. Welcome, Nathan. You have a great background. I love it. It just lends a lot of weight to your opinions and words of advice you're going to be giving our listeners. So I'd love to pick your brain and start off with your thoughts of this past year, maybe hitting some highlights or some interesting conflicts maybe that have happened this year. What has materialized, what hasn't, and what is most interesting to you in talking about 2023?
Sure. I think you got to wind back the clock and think about where we were heading into this year. And really, it's all about the Fed's hiking cycle, really increasing the cost of capital and hijacking the capital markets. You saw stocks and bonds come under severe pressure in 22. 22 was one of the worst years for the bond market on record. And after that, we really saw issuance activity fall off a cliff. Equity markets activity there has been abysmal and really bad in the IPO market. And what's interesting is even though we've seen stocks recover as we've seen the pace of rate hikes slow, you haven't actually seen the equity markets open up. It's been a big question of how high will the Fed have to go and what will the cost to the economy be as a result of that rate hike cycle. And everybody's really in wait and see mode on that. Same time, we actually saw the bond market stabilize. 22 was a terrible bond market, and you saw issuance activity really plunge. But we've seen credit spreads tighten there, and you've actually seen pretty steady issuance activity in terms of investment grade issuance. So some hopes of optimism there that next year looks a little bit better. But the part that has certainly been a massive overhang on all capital markets activity and the outlook for the economy is what happened with the banking sector beginning in March, where you saw the Fed's aggressive rate hike campaign lead to three massive bank failures, the second, third, and fourth largest bank failures we've ever seen in U.S. history. And we can unpack those a little bit more, but that definitely changed everyone's view of the economy. It changed the view of the banking sector in a very negative way, and valuations there have been under severe pressure. You have this weird dynamic where you've got the broader market looking okay, but financials, which are thermometers of the economy, under really considerable scrutiny. And as a result, we've had very slow issuance activity and investors be really cautious when it comes to supporting new deals.
Mid-year, we did a big picture report recap, just checking on things that have materialized, what may not have materialized. And when you talk about earlier in the year, when we saw some of those financial banks fail, the run on banks, which happened in March, it was interesting because I was with my colleague Chris Stroh on that episode, and we were talking a little bit more about the disconnect between investor sentiments in terms of confidence and positivity and how that was impacting the markets and just pure fundamentals. So you mentioning the financials and fundamentals diverging from what's going on with the optimism in the market is an interesting point that we would be remiss not to discuss a little bit more and not forget about, because as we see the upswing again in the markets, it's a little bit confusing on how the markets can be positive when fundamentals might be shaky and markets are positive when things seem to be going all right. Thinking about mid-year earnings call sentiment and based on S&P data, what we saw, again, was some of the most positive earnings call sentiment we've seen at a time when the actual financials didn't really quite line up with the optimism. Let's take us back a little bit. I understand that you were in a unique position when that run on banks happened and what happened with Silicon Valley Bank and some of those other bank failures. So I wanted to pick apart that a little bit with you and what you saw and some of the takeaways from that crisis.
At that time, we were always talking about things that was really a tale of two cities when you talked about the economy and markets. On the one hand, you've got unprecedented bank runs that began in March, beginning with SVB. And when I say unprecedented, let me put in some context and runs that occurred. After you'd had rates go up considerably in 22, that left most of the assets that banks owned severely underwater, most notably bonds that were down 10 to 15%. And Silicon Valley was no different there. But the difference with them is that they had seen their deposits decline by about 4x of what you had seen in the industry. Banks don't plan on losing their deposits in a given year. They tend to see growth. In fact, we hadn't seen outflows for many years from the industry, but Silicon Valley had actually seen it at about 4. And as that occurred, they needed to raise cash to meet those outflows and did so by selling their deeply underwater bond portfolio and announcing plans to raise capital, which proved to be a bad strategy because they didn't have the capital in hand, and it kicked off the run on the bank. And the run on that bank was unprecedented. 25% of their deposits left the bank on a single day. And the next day, the day they were actually closed, 60% were expected to leave. Just to give you some context there, the previous largest single day bank run was Continental Illinois in 1984, when they lost 7.8% of their deposits in a single day. So about 4x that of anything we'd ever seen. And for folks who don't remember 1984, they might remember Washington Mutual, which is the largest bank that ever failed. That lost just 2% of their deposits in a single day. So nobody had ever seen anything like this. No doubt the shift to digital was a big part of that. So you see that and you think, my God, this is terrifying. That happens. Signature goes down a few days later, also has an unprecedented run, 25% of their deposits in a single day. And then we now know that First Republic, over the week that followed, lost about half their deposit base and limped along until they eventually were closed about a month and a half later. So how can you have that in bank stocks and financials, again, the thermometer economy, sell off 50% and everyone still have positive sentiment? And it's because Main Street was still doing okay. The consumer was still pretty strong. We had record low unemployment. Jobs kept growing. The consumer was still healthy, still had very strong balance sheets. You saw wages continue to grow. You saw basically most people's balance sheets, both consumers and corporates, look healthier even on the back end of that, despite that. So it's this very strange thing where you've got huge financial turmoil, which normally coincides with a recession. And we wake up every day talking about the prospect of recession and just not seeing the underlying economy. And now 8-9 months later, we're all talking about the prospect of a soft landing as inflation is getting under control and rates have gone higher. And the bank's really not showing much cracks in the credit armor, so to speak. So no doubt there were some serious issues at those institutions, and they had serious interest rate problems and had not prepared their balance sheets for increases in interest rates. But it's this odd dynamic where you have, again, the second, third, fourth largest bank failures in U.S. history, unprecedented bank runs, and the economy's still okay.
I hold the exact same sentiments there. It was just, to me, those seemed like giant red flags waving in my face. I'm like, this is not good. This does not bode well for the rest of the year. And yet we did see positive sentiment lift in the first half of the year. And it's still going higher. I'm just looking at our Q3 roundup in terms of net positivity, and that's even higher than it was at half the year or mid-year, excuse me. And to me, I don't know about the rest of the world, but to me, it just makes me a little bit more reluctant. My follow-up question to you in terms of banking and those bank runs, the bank industry is one of the heaviest regulated industries. Do you think maybe some of that positive sentiment was, if we're able to catch this and weed out some maybe the softer banks or the weaker banks, and we're still chugging along, do you think that then is just like a good sign of things to come, and that's how people are interpreting this?
I think that's fair. They didn't necessarily catch it because they did fail, but guess what? We moved on. And I think that's the way you framed it exactly right. That if you had told me in November that we would be 8 months removed from those runs and that you wouldn't see massive turmoil in the banking industry, you wouldn't see massive spillover, it wouldn't be a harbinger of all kinds of problems that exist, I would have said that's impossible when you see those things play up. And if I think back to '08, you certainly saw some dominoes fall early, and they were harbingers of things to come, and they haven't come. I think that definitely has played into it, the fact that, yes, it was tumultuous for a few weeks. Yes, regulators had to step in and announce all kinds of emergency programs to help shore up funding in a few institutions, but they were able to find buyers and we have moved along. So I think it is that issue that you didn't see continued spillover, and that some other institutions who were very much on the crosshairs and of great concern in the investment community were able to move through it and get back to normal banking. So I do think that's a big part of it.
Part of my uneasiness is I graduated college and I had just started my financial job and the world was kind of falling apart. And so now seeing the bank runs this year maybe gave me some visceral experience or reaction to seeing those banks fail. But maybe that's just me, or maybe the economy just has a short-term memory, like a little goldfish.
Well, there are some differences, and it probably is worth unpacking them a little bit. If you think back to '08 and you think about a lot of the problems that happened where you had massive amounts of leverage, 30, 35 to 1 at the big investment banks, or of the 515 banks that failed, many of them being small, many of them were funded with hot money, broker deposits, 30, 40% of their deposit base, and about 40, 50% of their loan portfolios were in things like construction loans. And in places like Atlanta, where 90 banks failed in Georgia, 88 in Metro Atlanta, and they were all pretty much doing that, spec construction of lending related to housing. We haven't seen that this time. Nothing like that. In fact, the banks that failed were upside down from an interest rate standpoint. And they had very high concentrations of uninsured deposits, which in itself isn't necessarily that big of a problem. But if there's concerns about your viability, then your deposits are not necessarily that stable. A fancy way of saying it's really easy to pull the money out of the bank very quickly. Silicon Valley, 90% of the deposits uninsured, Signature 89, First Republic 78 versus 45% across the industry. They also have lots of their assets and long duration assets that got hammered when rates went up. And again, outside exposure to those. So you can really look at them and say they're outliers. And again, not a harbinger or representative of what we've seen out there. The other thing I would say is different in '08. The joke I've been having is it's amazing what happens when you throw $10 trillion at a problem, which is what happened post-COVID. So the consumer is still living on a lot of stimulus and excess savings that they accumulated. You also have corporates that refinanced their debt in 20 and 21 when we had record levels of debt issuance. So they're sitting on pretty low debt services. So balance sheets were good heading into this one, whereas heading into '08, everybody was stretched.
Yeah, that's a fair point. I like that. Just being able to outline what's a little bit different from '08 to today and why we're able to rebound and move on so quickly. So just thinking about where we are now in terms of interest rates are down, but we got positive market reaction there. Valuations also down dramatically. I've read many opinions that echo what I was listening to CNBC the other day. They had Sequoia Capital's roll off both on there. And he was like, valuations will normalize as the interest rates come down. And he wasn't really worried about that. So just wanted to pick your brain a little bit on what's your take on where we are today and looking forward to closing out Q4. What does that look like?
I think the entire investment community has been waiting for peak rates, certainly hoping for a pivot to down rates, but the idea of at least peak rates would increase animal spirits, so to speak, in the capital markets. Our investment manager index survey, the October edition, we asked participants if their investment appetite would increase or strongly increase if Fed funds rate had stabilized or effectively peak rates. And 70% said yes. It's a pretty strong indicator that they're waiting on that. And the idea there is that, yes, the cost of capital is higher in a higher rate environment, but at least we know what it is. It's not moving any longer. And we also can start to judge the economy against a more steady rate environment. And we saw on full display how the market's likely to react to that even beyond our survey when you had the latest inflation print come out with a consumer price index increasing, yes, just over 3% year over year, but importantly didn't move month over month. And you saw the broad markets rally like crazy. You saw the 10-year treasury yield come down, the bond market rally like crazy, and you saw the expectation for potential Fed cut change considerably as well, with the Fed possibly cutting as early as March, greater probability, about 50% in May. That's what the futures market was pointing to. And before then, people were thinking later in 24. So that gives a little bit of the wind in the sails in terms of valuation activity. But I still think we're in the show me story where we need to see how the economy holds up. Can we continue to plug along in the face of higher rates? There's a lot of things people are watching around the health of the consumer, but also things like the commercial real estate market that we spend a lot of time talking about. What does that look like? Is there's a massive maturity wall lying on the horizon? And each month we get further without another shoe to drop. I think that supports valuations where we are. That supports markets. And that gets closer to where markets are more open from an equity issuance standpoint.
We had a call earlier. There was something interesting that you mentioned that I wanted to make sure we covered. You were talking a little bit about how Western Alliance was able to react to some of the market activity. And then you had mentioned a lot of investors are in this wait and see pattern, and it's remaining a quote unquote show me story. Can you just unpack more around Western Alliance and what you learned there?
I think they're a great case study and call it crisis management, honestly. For listeners who don't know, they're a regional bank that has a $5 billion market cap, about $70 billion in assets, which might not sound like a lot against the $3 trillion of the likes of JP Morgan, but it puts them in the top 60 banks in the country. And they're based in Phoenix, and they were in the group of banks that really got targeted by investors for a few reasons. They had high concentration of uninsured deposits. They had a lot of commercial clients, and they were perceived to have pretty big exposure to the technology sector. Silicon Valley was a tech-focused bank, and the reason why people got worried there is that tech is under stress. When money was free, there was plenty of cash rolling into the sector. As rates started to go up, the cash burn rates in those spaces got much higher. And so some in the investment community deciding that they were going to face the same fate as some other institutions, and they faced considerable pressure on their stock price. And the odd thing about this is you started to have situations where short sellers would come and bang up banks, and depositors started to move their money out. PacWest was another one who eventually had to merge with another institution, Bank of California, and had faced their deposits actually leaving the bank. Western Alliance faced some stretch there, but they came out and really ran a masterclass on communicating with the street. One, providing weekly updates, basically showing that they weren't having problems. And one of the ways we eventually found out that they were able to do that is they contacted their largest depositors and had them sign non-disclosure agreements, something I never heard of doing before, and said, hey, this is what the books look like. You don't have any reason to pull your money out of the bank. And as they were able to come back and show the investment community, look, the money is still here. Our deposits are safe. We're not seeing anything close to a run on the bank. You've seen the stock double from the lows. I mean, it took severe pressure. But the takeaway is that they rethought everything they ever thought about what was, one, important to communicate to the street, and two, how they could do that, how they could come out mid-quarter. And they're not the only ones who did some different things. I think there's the most extraordinary with signing NDAs with their customers. But the level of granularity that we saw banks come out with in the height of the storm, I think was a good lesson learned for anybody in the investment community. When your investors start to get worried about certain things, sunshine is the best disinfectant. And so they came out and provided greater detail on the breakdown of their deposit base, accounts by size, exposure to different sectors. Hey, we're not related to crypto or tech. We saw some of the best banks in the country come out and really do this. They were able to really build support in doing so. Now they're still down, bank stocks down 20% year to date. People are concerned about credit. People are concerned about the ability to test higher rates, but they were down as much as 35 or 40%. So they've recovered quite a bit. A lot of that, I think, has to do with being proactive and communicating with the street actively.
Yeah, I think that's a great lesson for my audience, just taking a look at crisis communication. To your point, just trying to be as transparent as you possibly can be with your investors to regain confidence, I think is a great lesson to take away there. Honestly, like if a bank can do this and be innovative on their communication and how to handle crisis like that, it's like anyone can do it, right? So I thought that was a super interesting lesson in crisis communication that you had experienced almost in real time. I think that was a really crazy story.
One of the other weird things, though, that came from that was you had recommendations for most banks to come out and say, look, you don't need to provide that level of update. Meet the investment community where they are. And the point there being was, if you go out there and say everything's okay and flash an everything's okay alarm, somebody's going to think there's something wrong going on. But if your back is against the wall, if you're already facing pressure, don't ignore it. So it's really recognizing where the street is. And I think that's probably true of even outside of crisis times. One of the things that we're looking at in my space right now is, okay, banks want to go on offense. They want to get on the other side of higher rates, really punishing their portfolios. How do they do that? Figure out what is the best part of your story that your investors like, and figure out how you can lean in on that and why purging some problems you might have get you away from the negative side of that story, figuring out how to take control of the conversation. And one other point I would make was we heard a number of advisors recommend monitoring social media, which is something that we had never really heard people do before, with the idea that if a negative opinion gets out on you and goes viral, then you have a serious problem. So it's something that needs to be in the IR playbook going forward for maybe all spaces, that even if you think it's silly, you need to be aware it's there to have an answer ready in case it ends up on your front door with some of your big investors being really concerned.
Exactly. And just with the volume of information that's out there, it's really important for IR programs to have their thumbs in on everything, even if it may, like to your point, seem silly to be like on Twitter or TikTok or wherever it may be, just to get a temperature check of what people are talking about and get ahead of that. And this really resonates closely with a lot of the conversations I'm having around sustainability and the upcoming regulations we're expected to be passed by the SEC, all the regulations that are being passed through the CSRD. It's just much better to be proactive in your communication and in your sustainability strategy. And that plays into your overarching strategy, and you can still remain profitable, even though we're taking into consideration sustainability, supply chains, for example, and mitigating some of that risk. To your point, as an IR program, you really want to be proactive in making sure you have your thumbs in things and you have your gut checking the temperature with your investors and just with the wider market. So thank you for sharing that experience. I appreciate that. Looking ahead, when thinking about 2024, so I have the big picture capital markets outlook report in front of me, and let me just read a snippet. Overall, the outlook for 2024 remains patchy, with weaker growth expected in most major economies, including the US. Sticky core inflation means that rate cuts in advanced economies remain some way off. So Nathan, could you translate for us what that means exactly for 2024 debt issuances, equity issuances, and IPO activity?
I think the debt markets have shown signs of stabilizing. If the Fed is able to come close to something of a soft landing and rates are stable, I think that'll be good for debt activity. There's almost always buyers of that paper, particularly at rates where they are today, much more attractive than what we've seen. You have lots of big institutional money, whether it's banks, pension funds, insurance companies. So I think there'll be support of that absent a massive downturn, and that should help support some recovery in equities. And that's what we've put out there. But it's perhaps not that big of a bold of a call, just given how depressed issuance activity has been. And we had seen some signs of life in the IPO market, but some of the new deals that came out have not performed all that well post-issuance. But I think it's got to get to be a little bit better, because we're going to be operating in a world at least of where we know things are. Sure, you've got geopolitical risks hanging in the backdrop, whether you're talking Russia, Ukraine, or the Israeli-Hamas conflict, and neither of those are good for activity. But what we really need to see is equities rebound, and then that leads to more M&A activity, because so much of M&A is supported by equity issuance and the idea that acquirers have access to the capital markets and things like that. So I think it goes up. I think it gets better. And I referenced this earlier, but I think it's each passing month that we don't have some big shoe to drop. We don't have some evidence of a kind of hard landing on the horizon, that you're likely to see a pickup in activity. So it might not be in January, it might not be in February, but March looks better, April looks better, as long as we continue on this trajectory of where we are today.
I'm curious here. So far what we've seen this year, the theme is positive sentiments despite whatever else is happening, right? Whether it be geopolitical, whether it be fundamentals, it's just people are remaining optimistic and just pushing forward. What would be the shoe that would drop that would cause things to come to a halt?
Great question. I think a couple of things. I think if you start to see the consumer really struggle, we've seen inflation come down, but if you start to see that spending, which has been incredibly resilient in the face of higher rates, really slows. And that leads to lower sales on a retail basis. Then you see companies start to right size accordingly and start to say, we're going to spend less. And then that spending less leads to even broader efficiency plans and then leads to a place where you start to see unemployment creep up. And most economists are expecting unemployment to come up. But what I'm talking about here is beyond what they're expecting of a half a point or maybe even a percentage point by year end 24, but something more material there where corporate America thinks that they need to hoard enough cash or save enough in terms of expenses that it leads to considerable levels of layoffs. I think that would definitely change the investment community's opinion of where we are today, because that's not really been the case. That's been the fear, but it's not shown up yet. The consumer has remained really resilient. The other one that potentially is out there, again, I mentioned commercial real estate, that you actually see this maturity wall that is spread out more than most people think. It's not all hitting in the next year, but you actually see that lead to some real pain, and that has a cascading effect as well, where you're starting to see landlords get into real trouble. That puts pressure on property values, and that leads to another wave of defaults for anybody who has an asset class that's similar to there. I'm not so much in that camp. I really think it's going to be tough, but I think it's more of a longer slog, 3 to 4 years of the way this thing works out. And one of the things underpinning all of this that kind of supports the idea that maybe that's not that big of a risk is there's still a lot of money out there. There's still tons of dry powder out there in private equity and venture capital's hands that they're not going to return to their investors. So they're going to put it to work, and they're waiting for cheap deals right now. But I think that gives us a little bit of a floor here that keeps things from getting a little bit too ugly.
So that makes sense to me. And it's also, as I was reading some of these interest rate stories and market reactions, like, unemployment's rising. Yay, so market rally. But to your point, in terms of consumer spending, I think that would be very interesting to keep an eye on, especially as we go into the holidays and see if there is a tightening of wallets happening at the consumer level. All interesting things to keep an eye on, I think.
We're a service-driven economy. Remember that. It's 70% of the economy. So if the consumer is able to remain resilient, then things won't get that ugly. It doesn't mean that they couldn't have challenges right now. I think most people are expecting at least slower growth. That is somewhat baked into a lot of assumptions today. So it would need to be uglier than that to really, really change the outlook for capital markets.
Nathan, I think we're almost out of time here. And I always love to close out these podcasts with a final word from our expert. To keep it tight and tangible, what is one piece of advice you would give our listeners when it comes to thinking, planning, and managing for 2024?
Think about the best part of your story. Figure out how to lean into that. And on the flip side, think about the thing that people are most concerned about and don't hide that. Find a way to change their mind that it's not as big of a risk as they think it is, or what you're doing to pivot away from it to move forward. I've said this for the last few years, maybe it's because it's been a volatile environment. The idea if you just take what the economy is going to give you, that's not a great strategy. You need to take control of the message. I would say that to every IR person, but I've said that to banks for the last few years too. You need to innovate, you need to pivot, you need to be nimble, you need to be agile, all those good words. Get out there and play offense and sell the good part of your story and figure out how to convince everybody on the other side what they're most concerned about, why they don't need to be that worried about that.
I can't tell you how many times I've said be proactive on this podcast. It sounds like you have very similar theme when it comes to how to manage messaging and manage stakeholders, investors, and Just be proactive with it. Thank you so much, Nathan, for joining us. It was a pleasure to have you and your insights and your point of view. I really value that. I hope our listeners gained actionable insights on what's in store for 2024 and some tips on messaging and how to better engage with your investors. If you like this content, please subscribe. And until next month,